Welcome to Dr. Fred Markets. This is not financial advice. Every day, the world of finance, crypto, and artificial intelligence moves fast, really fast, and staying informed is the only way to stay ahead. That's exactly what we do here, together. Let's get into today's video.
AI isn't killing jobs first, it's coming for your portfolio. Here's the verdict. Crypto is slowly divorcing from AI stocks, and most people are still trading them like a toxic power couple. Bitcoin first, sitting at $76,446, up 0.88% on the day. That's not a meme move, that's a slow, confident flex near all-time highs. Ethereum tags along at 2,265, up 0.52%. This is what strength under pressure looks like. Modest green, while the rest of the risk universe is staring at the Fed like a deer in Powell's headlights. At the same time, the S&P 500 barely twitches, up 0.4%. Little changed according to CNBC, as everyone prays through big tech earnings and the next Fed decision. Translation: legacy markets are that guy who just needs a minute before making every decision. In other words, paralyzed. Now look at Nvidia, $200.51, down 4.18%. That's not random chop. That's air leaking out of the AI balloon. Nvidia has been the poster child, the priest, and the drug dealer of the AI trade. When it bleeds 4% in a quiet tape while crypto holds green, that's not noise, that's rotation. Layer on top of that the Reuters bomb. Families of Canadian mass shooting victims are suing OpenAI and Sam Altman in a US court. This is a line in the sand. Not AI will change everything brochure talk. Legal liability, in writing, in front of a judge. That's the moment the hype cycle meets discovery. Signal 1, crypto strength into macro fear and AI wobble. Bitcoin and Ethereum drifting higher while Wall Street braces for the Fed is not a sideshow. It says, we don't care about your rate anxiety anymore. For years, BTC behaved like a high beta tech stock. Now we get this. Green tape in crypto, red in AI leaders, and a nervous S&P. That's not correlation, that's a custody battle. Signal 2, AI is leaving the magic future phase and entering the who goes to jail when this goes wrong phase. When gun victims' families sue OpenAI over alleged AI involvement, every institutional lawyer in America hears the same thing: compliance nightmares, risk disclosures, and new lines on the balance sheet called legal reserves. That doesn't kill AI, it taxes it, heavily, and markets hate new taxes on their favorite story. Signal 3, the AI narrative is getting commoditized and domesticated, while crypto narrative is getting bigger and cleaner. Look at Uber. They're in the hotel business now, thanks in part to AI. That's Silicon Valley code for, we stuck an algorithm on top of a logistics problem and called it AI so the board stops asking questions. AI isn't a mystical frontier there, it's plumbing. Meanwhile, Bitcoin is still the only global, neutral, non-corporate monetary asset you can trade 24/7 without asking Larry Fink for permission. Here's the cliffhanger. We are one nasty AI headline away from regulators going nuclear on the space, while crypto quietly absorbs the anti-system capital that used to hide in high beta tech. So what do these signals actually say when you stop drinking the Kool-Aid? They say this: AI as a stock story is peaking, while AI as infrastructure sinks into the background, and crypto is stepping up as the main event in the bet against the old system trade. Nvidia pukes 4%, while Bitcoin shrugs and climbs. That's not just a chart, that's a confession. Wall Street used AI stocks as their future hedge. Now the future has lawyers, compliance memos, and congressional hearings. Traders don't pay up for that. The OpenAI lawsuit is the spiritual opposite of the Bitcoin white paper.
Does what you just heard make you want to learn more, to dig deeper, to ask better questions? That curiosity is exactly what separates people who understand finance from those who don't. Most people stop at the surface. You're going further. Let's continue.
One is, here's a permissionless protocol. Use at your own risk. The other is, we used your shiny centralized AI. Now explain it to a jury. That's the fork in the road. AI is centralizing power and now centralizing blame. Crypto is decentralizing power and pushing blame to individual choice. Markets understand that distinction before voters do. Uber using AI to shove people into hotel rooms is cute, but that story says AI has already turned into electricity. Invisible, essential, and unsexy. You don't get 20x multiples for electricity, you get regulated, squeezed, and taken for granted. Crypto, on the other hand, still scares central banks, annoys regulators, and divides families at Thanksgiving. That's exactly the kind of thing that deserves a volatility premium. Meanwhile, the S&P hugs flat, paralyzed by the Fed, while USO, the oil ETF, actually drops 3.37%, even as the headlines scream about rising oil. The real economy trade is confused. The AI trade is getting litigated. But the crypto tape is clear. New highs are no longer science fiction, they're baseline expectation. This is not financial advice, but here is the truth. If you still trade AI stocks and crypto as the same risk-on tech bet, you are living in 2021. The market has already started the divorce proceedings. AI is trending toward a regulated utility with superstar marketing. Crypto is trending toward the last clean macro speculation that doesn't rely on some CEO not saying something idiotic on an earnings call. So what does this mean for you, sitting there doom-scrolling Fed headlines? First, stop pretending AI equities and crypto belong in the same mental bucket. One lives or dies by regulators, liability, and quarterly guidance. The other lives or dies by protocol risk, network effects, and raw human greed. Different beasts, different cages. Second, respect the price action verdict. Bitcoin up 0.88% near highs, Ethereum up, while Nvidia dumps over 4% on a sleepy day, tells you where the speculative crowd is quietly migrating. When the big AI darling bleeds and the boomer boogeyman asset rallies, the smart degenerates are already repositioning. Third, ask one brutal question before you put $1 anywhere near AI. Who gets sued when this breaks? Then ask the crypto question. Who can be stopped if this wins? If the answer to the first is a company with a ticker, you're buying legal risk. If the answer to the second is nobody, you're buying political risk. Both are dangerous, but at least know which poison you're drinking. Here's your 3-point summary, no sugarcoating. 1. Crypto is quietly decoupling from the AI hype cycle and trading like its own macro asset, not a tech sidekick. 2. AI's center of gravity is shifting from limitless upside to limitless liability, which crushes multiples even if the tech keeps improving. 3. The real future bet isn't AI versus crypto, it's centralized, litigated innovation versus decentralized, permissionless chaos. This is not financial advice. This is a reminder that the market stops rewarding fairy tales the minute lawyers walk in. If you want more unvarnished takes on where crypto and AI actually matter, not where CNBC wants them matter, hit subscribe, share this with the smartest cynic you know, and stop letting other people's narratives babysit your money. This is not financial advice. If you enjoyed this video, please subscribe to the channel and check the links in the first comment below.
That's it for today on Dr. Fred Markets. I hope this gave you clarity and a new perspective. Remember, this is not financial advice. Always do your own research. If you found this useful, subscribe. It's free and it helps the channel grow. Find me on the blog at drfredmarkets.com and join the newsletter via the link in bio. I'm Dr. Fred Markets. See you in the next one.